VTI versus VOO feels like one of the biggest ETF decisions for long-term investors. And it makes sense. Both are cheap, both are popular, both are from Vanguard, both give exposure to the US stock market, and both can work extremely well as core holdings. But here's the important part. For many investors, the answer is simpler than they think. The real question is not which ETF is perfect. The real question is which exposure you actually want. Do you want the S&P 500 or do you want almost the entire US stock market? That is the real difference, not hype, not tiny fee differences, not trying to guess which fund will win by a small margin next year. So in this video, we are going to break down VTI versus VOO in a practical way. What each ETF owns, why their returns often look similar, where the overlap is, who may prefer VOO, who may prefer VTI, and the biggest mistake investors make when buying both. The wrong question is which ETF is perfect. The right question is which exposure you actually want. Let's start with VOO. VOO is the Vanguard S&P 500 ETF. It tracks the S&P 500 index, which is one of the most famous benchmarks in the entire US stock market. In simple terms, VOO gives investors exposure to large-cap US companies. These are many of the largest, most established businesses in America. That is why VOO is often used as a simple core holding. It's easy to understand, it's low cost, and it gives exposure to the largest core of American business. VOO has an expense ratio of 0.03%, so cost is not really the issue here. For many investors, VOO is attractive because it's clean and simple. You're basically saying, I want the S&P 500 as my US stock market core. VOO is simple. Own the biggest core of American business. But VOO is not the only simple option. That brings us to VTI. VTI is the Vanguard Total Stock Market ETF. Instead of tracking only the S&P 500, VTI tracks a broader US stock market index. The goal is to give investors exposure to almost the entire US stock market. That includes large-cap stocks, mid-cap stocks, and small-cap stocks. So if VOO is the S&P 500 answer, VTI is the total US market answer. VTI also has an expense ratio of 0.03%. So again, cost is not the main difference. The appeal of VTI is that it gives broad US stock exposure in one fund. You do not have to decide separately between large caps, mid caps, and small caps. You get the whole US market structure in one ETF. VTI is simple too. Own almost the entire US stock market. Now that we know what each fund does, we can compare the real difference, S&P 500 versus total market. The real difference between VOO and VTI is exposure. VOO tracks the S&P 500, so it is focused on large-cap US companies. VTI tracks the broader US stock market, so it includes large caps, mid caps, and small caps. That makes VTI broader than VOO. But there is an important detail. VTI is still market cap weighted. That means the largest companies still have the biggest weight. So even though VTI owns more companies, the largest US companies still dominate a large part of the fund. This is why VTI and VOO are not as different as many beginners expect. VTI includes more of the market, but both funds are still heavily driven by large-cap US stocks. So yes, VTI is broader, but both funds are more similar than people expect. And because both funds are so low cost, the decision does not really come down to fees. When people compare ETFs, fees are usually the first things they check. And that is a good habit. Fees matter. A high fee can quietly reduce long-term returns. But in the case of VTI versus VOO, fees are basically a tie. VTI has an expense ratio of 0.03%. VOO also has an expense ratio of 0.03%. That means this is not really a fee battle. Both are extremely low-cost ETFs. For a long-term investor, that is a major strength. But it also means fees should not be the deciding factor. The better question is not which one is cheaper. The better question is, which one gives me the exposure I want? Do I want the S&P 500 or do I want the broader US stock market? This is not a fee battle, it is an exposure decision. And because the exposure overlaps so heavily, the performance conversation can surprise people. VTI and VOO often produce similar results because they share many of the same biggest drivers. The largest companies in the S&P 500 are also a major part of the total US stock market. So when mega-cap US companies are driving the market, both ETFs often move in the same direction. That does not mean returns are identical. They are not. VTI has mid-cap and small-cap exposure. VOO does not directly include the same full total market exposure, so there can be differences. But the differences are often smaller than investors expect because large-cap companies dominate both funds. This is why trying to predict which one will outperform by a small margin can become a distraction. The bigger decision is portfolio philosophy. Do you want a pure S&P 500 fund, or do you want the broader total US market? When the biggest companies drive the market, both ETFs tend to move together. And that brings us to a risk many investors do not think about enough: concentration. Both VTI and VOO are diversified, but neither one is equally weighted. That is extremely important. Market cap weighting means the biggest companies get the biggest weight. So if the largest companies become a bigger and bigger part of the market, they also become a bigger part of these ETFs. VOO's top 10 holdings represented 37.8% of assets in the Vanguard fact sheet. That shows how much large companies can matter inside the S&P 500. VTI owns more stocks, but it is still heavily influenced by the largest companies too. So investors should not assume that owning hundreds or thousands of stocks means every company has the same impact. That is not how market cap weighted ETFs work. The biggest companies can drive a lot of the return. They can also drive a lot of the risk. Both ETFs are diversified, but neither one is equally weighted. So when people say VTI is more diversified, we need to be precise about what that really means. Is VTI more diversified than VOO? Yes, by number of holdings and by market coverage. VTI includes large caps, mid caps, and small caps. VOO is focused on the S&P 500, so VTI gives broader exposure to the US stock market. But broader does not always mean dramatically different. Because VTI is market cap weighted, large cap companies still dominate the fund. That means the practical difference may be smaller than the holdings count suggests. More companies can help, but more companies do not automatically mean much lower risk, and they do not automatically mean very different returns. The real benefit of VTI is that it removes the need to choose between large caps, mid caps, and small caps. You get the total US market in one fund. VTI owns more companies, but more companies does not always mean a dramatically different portfolio. So now we can move from fund structure to investor fit. Who may actually prefer VOO? VOO may make sense for investors who want the clean S&P 500 answer. Maybe you want large-cap US exposure. Maybe you like using the S&P 500 as your benchmark. Maybe you want a simple, famous, easy-to-understand core ETF. Or maybe you already own mid-cap and small-cap funds separately, so you do not need VTI to include those inside your core position. VOO can also appeal to investors who want maximum simplicity. It is one ticker, one famous benchmark, one clear role. And for many people, that is enough. The key is understanding what you are choosing. With VOO, you are choosing the S&P 500. You are not choosing the entire US stock market. That may be completely fine, but it should be intentional. VOO is for investors who want the clean S&P 500 answer. Now let's look at the other side. Who may prefer VTI? VTI may make sense for investors who want the whole US market in one fund. If you do not want to separate large caps, mid caps, and small caps, VTI solves that problem. It gives you a broader US stock market core. It also reduces the need to add a separate small cap fund just to complete your US stock exposure. For investors who want fewer decisions, VTI can be very appealing. You do not have to ask whether small caps are about to outperform. You do not have to decide how much mid-cap exposure to add. You simply own the broad US stock market. That does not mean VTI is guaranteed to outperform VOO. It is not. It just means VTI gives a more complete U.S. stock market exposure. VTI is for investors who want the whole U.S. market in one fund. And if this kind of simple ETFs breakdown is useful, this is a good point for a quick pause. This is the kind of ETF comparison we focus on at Boring Money Wins. Simple investing. No hype, no panic, no pretending that a tiny performance difference is the only thing that matters. The goal is to understand what you own, why you own it, and how it fits into your portfolio. So if this kind of no-hype ETF breakdown is useful, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want simple investing without the noise. Now that we understand VTI, VOO, costs, performance, concentration, and investor fit, let's talk about the biggest mistake investors make with these two ETFs: buying both and thinking it creates major diversification. The biggest mistake investors make with VTI and VOO is buying both because they think it creates a lot more diversification. Buying both is not automatically wrong, but it is usually not the diversification investors think it is. Why? Because VOO is largely already represented inside VTI. The biggest companies in VOO are also major drivers of VTI. So if you own both, you may simply be increasing your exposure to the same large-cap U.S. companies. That can create false diversification. More tickers, more lines in the portfolio, but not necessarily much more true diversification. It can also make the portfolio more confusing. You may think you have two separate strategies, when in reality you have a lot of overlap. Again, owning both is not illegal. It is not a disaster, but it should be intentional. Buying both is not wrong, but it is usually not the diversification investors think it is. So instead of asking whether you should own both, ask how either one fits into the rest of your portfolio. Neither VTI nor VOO is a complete portfolio by itself. They are both U.S. stock ETFs. That means they do not automatically give you international stocks. They do not give you bonds. They do not solve asset allocation, and they do not decide your risk level. If you use VOO, you may choose to add a small cap ETF if you want exposure outside the S&P 500. You may also add international stocks and bonds depending on your plan. If you use VTI, your U.S. stock exposure already includes large, mid, and small caps. But you may still want international stocks and bonds. So the key is portfolio construction. VTI or VOO can be a strong core, but they are not the whole plan. Neither ETF is a complete portfolio by itself. And that brings us to a simple way to decide between them. Here is the simple decision framework. If you want pure S&P 500 exposure, choose VOO. If you want the total U.S. stock market, choose VTI. If you already own small caps separately, VOO may fit better. If you want fewer decisions inside your U.S. stock allocation, VTI may fit better. If you're expecting a huge difference in long-term returns, you may be asking the wrong question. These two ETFs are more similar than most people think, so the decision should not be based on trying to predict the next tiny performance gap. It should be based on exposure. VOO is the clean S&P 500 answer. VTI is the broader U.S. market answer. Choose based on exposure, not on trying to predict the next tiny performance gap. Now, let's bring everything together into the final verdict. So, VTI versus VOO in 2026. Which one should you actually buy? The balanced answer is that both can be excellent long-term ETFs. Both are low cost, both are simple. Both can work as a core U.S. stock holding. VOO gives you the S&P 500. VTI gives you the broader U.S. stock market, including large caps, mid caps, and small caps. The best choice depends on which exposure you want and how the ETF fits into the rest of your portfolio. For many investors, either one can work. The bigger mistake is constantly switching, overthinking, or buying both without understanding the overlap. The ETF you can stick with usually beats the ETF you constantly second-guess. That is the boring answer, and boring money usually wins, because boring money usually survives.